Tyler, plenty of investors are still interested in dividend stocks, a category of stocks that whether you want the income or you want the yield, as a cohort, dividend stocks generally have been one of the best performing groups of stocks to own. You want to talk about some of our favorite dividend stocks right now?
I'm always in the mood to talk about dividend stocks, Jason.
I'm really excited about the one that you want to talk about because, yeah, in your typical fashion, it's certainly obscure and how its dividends are paid is interesting, but it's really easy for a lot of investors to miss. And it's a great opportunity to learn about a new investment. I'm going to talk about one of my old favorites, and this is one that you own too. So we'll get to that in a minute. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link, fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Okay, Tyler, you kick it off. You're going to talk about Captain Obscurity. That's your superhero name. You're going to talk about Investors Title Company.
Probably not a lot of people have heard about this because it's a $300 million market cap company, so very small and not a lot of people buying it. Very thinly traded company. A lot of shares don't go back and forth on any given day. And because of that, if you are interested in a company that is very thinly traded, like Investors Title, there's a thing called limit orders. It's something you want to do where it's you set a price and then you only let your brokerage buy it at that price. Because if you put in a big order for a very thinly traded stock, you personally can move the market. So just a little note on something like that to keep in mind when you're investing in very, very small companies like this and thinly traded companies. So Investors Title, as the name alludes to, is they are a title insurance company. They underwrite title insurance for homes. It's a relatively easy business to understand. It's an insurance contract where the insurance title company says we have done sufficient due diligence to say that you own this house outright and there is no outstanding claims, whether it be a tax claim, a construction lien, or some other claim against your ownership that you or somebody else may not have known about and put you in claims court. So if it does go to claims court, Investors Title pays it out. That's how title insurance works. You pay a upfront fee when you acquire your mortgage. They underwrite it. They have a float, just like an insurance company, conservatively managed business. The founder still runs it. The guy's almost 90, still running the business. It does pay a dividend. It pays a variable dividend.
Talk about that real quick. I'm going to bring it up on the screen here. I want to start with the yield because a lot of times when people are looking for dividend stocks, they're going to be screening for yield. This is one, it might fall under your radar because like this with our Y charts tool here only shows a 1% dividend yield. But this is where how the company pays or returns cash to shareholders comes into play, right?
Yes. What Investors Title does is it pays two dividends every year. It pays a regular base dividend, which is typically what you're seeing when you see the yield for the company. It's very, very small. And then at the end of the year, they typically pay out a special dividend at the end of each year, which is more or less the excess cash that they don't believe that they need to hold in escrow to pay out claims, and they don't necessarily need to hold for their float. The owners of the company own a significant portion and they don't take very large salaries. So these special dividends have been the way that the owners of the company have paid themselves. So it gives you an idea of like why it does this the way it does.
You see that 46 cents on the screen. That's the base dividend,
Yes.
right? That you get. And then all of these spikes in the past, this is when they're paying out that excess cash flow. And Tyler, the stock price has been, for the company, I think it's worth pointing out, has been super volatile and it surged from 2020 through late 2021 because of expectations for housing and demand for housing. And now we're in this environment. I think it's worth pointing out so investors can think about one of the risks and where we are with the stock, why it has come down from the peak, is title insurance is something that you get on an existing home, right? It's what clears the title against any prior liens that may have fallen through. And existing home inventory is way down and it's really weak and it's questionable how much it's going to increase. And that's a potential implication for investor title. But to me, I think maybe you'll agree with this. It's one of the things that actually makes the stock attractive right now because it's valued based on low expectations, right?
Absolutely. Yes. Underwriting title insurance right now is in the absolute dumpster in terms of business. But the nice part is about this business, as we said, it has an investment flow. It earns interest income on bonds and stocks and real estate that it owns that cover up.
Quick definition of float. Float is largely, for insurers, you can almost consider it free money. When that premium is paid, they collect all their premiums and they hold the premiums, they hold that cash until claims come in. And then they pay claims out of that money. And that's called the float. Insurance companies get that float. They don't have to pay. It's not like a bank where they have to pay interest to depositors. You get that float and then you invest it in smart, safe ways that don't create high risk. And Tyler, I think this is what you were getting to. With interest rates being way up, that's really good for a company that has a float, right?
Yes. So with the interest income that they're currently making, they're a solidly profitable company, even though their insurance underwriting is in the absolute dumps. They underwrite contracts. They don't have a lot of staff because the people who sell the contracts are actually brokers. So they just pay commissions to that. So if they don't have to take on a contract, they don't have to pay commission, variable rate costs there. So when that's a crappy business, you can rely on the float, and that's what they're doing right now. And so you're getting a business that is solidly profitable just with its float in the anticipation that when housing does pick up someday, I don't know when, but when it does, you have the upturn of that from that business. Very, very cheap today, still profitable, not going anywhere, with a nice kind of long-term catalyst, if you will, to make this look pretty attractive today.
The secular tailwinds for housing are still incredibly strong in the US. Lots of people want to buy a house, whether it's a new house or an existing home. The silver tsunami of baby boomers aging and retiring is going to start freeing up more and more of that existing inventory over time. I think you're right. There's something really attractive here. I want to talk about one of my favorite stocks again, Tyler. This is one that you own too, that might be a better suit for dividend investors who are looking for higher yield. They don't want to depend on a special income and the volatility of a company's cash flows affecting how much that special dividend is over time. And that's Brookfield Renewable. I'm going to share on the screen the dividend yield for it. They pay a quarterly dividend. And the idea is that they want to grow it over time. And we see in its existence, Brookfield Renewable Corporation, it's a corporate entity, dividend yields about 4.8%. It's also available as a publicly traded partnership, and you see the dividend yield is 5.2% there, even higher. There's more tax implications. I'm not going to get into the specifics here, but the biggest, most important thing to know about this business is that over the long term, the dividend tail has been growth. You see this cut that happened right here back in 2020. This is when they spun out Brookfield Renewable Corporation. When that happened, the number of shares of Brookfield Corporation that you received from your ownership of Brookfield Renewable, the total dividends you received actually are still higher. So if you factor in that corporate action, your dividends are still higher. The key behind this business is they own and operate and invest in renewable energy facilities, sign long-term contracts, like 20-year contracts to sell the power from those facilities, locks in really good stable cash flows that they grow with rising interest rates, rising inflation, things like that. They have escalators built in, and then they return a significant portion of that back to investors in dividends. So if you're looking for a higher yield, more stable payout, consistent payout, and some growth of that payout over time, I think Brookfield Renewable is really compelling. The rise of interest rates that we've seen affected a lot of these companies, pushed their stocks down because the market generally has assumed that their cost of capital was going to go up and it was going to squeeze their returns. That's probably going to happen, but Brookfield Renewable has always been one of the strongest, has maintained a really strong balance sheet, and has some of the lowest cost access to capital of any player in its space. That positions it really well to be able to not just continue to pay its existing dividend, but to continue growing its assets, look for opportunities to acquire assets on the cheap. They've been the best buyer of discounted assets in this space for decades, and then turn that into dividend growth over the long term. So there you go. There's two interesting stocks for you to look at for those dividend hunters out there. If you're looking for even more great ideas, like I said before, go to our special link, go to fool.com/unscripted. The Motley Fool's got more great stock ideas for you for free. Check that out.